we don't seem to have a business cycle. And if you look at almost any economy since the COVID crisis, everything's kind of flatlined. So there's no obvious business cycle around. And, we can conjecture as to why that may be. Is it because fiscal policy is dominant? Whatever. But the fact is that there's none. There is a liquidity cycle, and that seems to be paramount. And the interesting point is, which I'm sure you'll attest, is that, financial markets are responded not to the real economy, they're responded to the liquidity cycle. That's what's going on. So we need to understand this, like it or not. I mean, it's become the paramount issue in markets as far as we can see. So I think that's true. And I think your point that about bill issuance is really critical. And, the way that we've sort of, I suppose, explained this before is to say what you're getting is a transition crudely from Fed QE to Treasury QE. And the Treasury are basically coming in and issuing a lot of bills. They're starving the market of long-dated coupons. So there's not the liquidity absorption that you would expect. People are being forced into the short end. Two things really come from that. I mean, one is that there is lower volatility in markets as a result. And in fact, we know the Treasury is very keen to actually keep volatility down, given the way they've upped these buyback programs. So that's significant. And if you get a lot of bill issuance and short-dated note issuance, the banks buy it with alacrity, because this is the sort of security the banks like that matches deposit growth. And if the banks are doing that, they're effectively monetizing the deficit. So I think that's the route to a trend increase in liquidity over the medium term. We know governments basically have to find ways to fund themselves. And what better through this mechanism?
And do you think that this stops them issuing at the longer end, or is it just a delayed process until they can get rates lower? And we'll come into that in a little bit. But is this a structural change that's going to ongoing? And because it's bills, that feels like ongoing stimulus, and it might change this whole cycle?
Well, I think the answer is that it continues until it doesn't. And the fact is, we know that these things always end badly because they tend to end in inflation. And that's the experience we've had in the 1970s. So it's going to go on as long as it does. And then it will be forced to stop, presumably, by concerns over an inflation pickup. Now, I think everything they're doing is trying to bury that inflation news by whatever means, fair means or foul. So we're never too sure what the inflation rate is. And I'm always, instructed by the fact that, one's personal inflation rate is always way, way above what you read in the CPI. So there's obviously a lot of manipulation going on anyway. But the fact is, you've got inflating asset markets, which is really attesting to the fact that you've got strong monetary inflation. And monetary inflation is not just a cycle, as we know, it's a trend. And that trend is accelerating. And I think what the world doesn't realize is that things have changed dramatically since COVID. We're in a world of monetary inflation, monetary debasement. It's not, as I keep stressing, it's not one of financial repression. It's one actually more, it's worse than that. It's actually monetary inflation. And you've got to start thinking about how to invest in a monetary inflation world.
Yeah. And, and both of our hypotheses is, long duration assets tend to do very well in that environment. And we've seen that with technology stocks and crypto. Gold has acted very well in this environment, as it should do. And, all the signs are there that the debasement is ongoing and it's not going to go away. One of the things that is interesting to me is obviously Trump and Bessent are focused on what they can do with the Federal Reserve. The shenanigans around changing the governor and various board members. Clearly, they want to see if they can force interest rates lower. I think personally interest rates are too high versus GDP or whatever your kind of real interest rate measure you look at, and that there's room for rates to come down 200 basis points, which allows them to refinance again. Any thoughts on the kind of Fed board shenanigans?
Yeah, I mean, I'm cynical enough not to think it really matters too much. I mean, at the end of the day, I don't think the Federal Reserve really controls interest rates, certainly across the curve. I mean, it's rather the other way around. Long-term rates tend to drive the Fed rather than vice versa. So, ultimately you've got to say, well, okay, what's the fair value for the long-term bond? And that has to be related to nominal GDP growth ultimately. So you're talking of something like about 5%. and then you take what is a normal spread between the short end and the long end. What is it? 125 basis points. So that gives you your benchmark for Fed funds. So there's not much they can do sort of either side of that. And they can dance on the head of a pin and come out with their projections. But in reality, the FOMC doesn't have that much sway, I don't think. It's really a signaling tool more than anything else, as far as I can see. What matters more is really the balance sheet, what they're doing there.
So you obviously like this video enough that you've got to the end. That's quite a big task. But listen, do me a favor, hit the like and subscribe button, and also check out what video's next, because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research, everything there to help you in your journey, just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.